Hello traders, this is Blake Morrow with ForexAnalytix and you're listening to the week ahead video for January 19th, 2020. This is a very important video. We are at all-time highs in the S&P. But before I get into how the FX market's going to respond or how it's possibly going to respond to where we're at, I have to mention this is our New Year offer. You have to take advantage of it. If you've been waiting on the sidelines to be part of the ForexAnalytix community, don't wait any longer. This is it. This offer is going to extend for another few days and then it's gone. It's not here for another year. So perfect time. And when you do so, doesn't matter if you're going to do the premium pricing and you take advantage of it, or if you really want to just do the light version. The light version, by the way, is only $19 a month. But to get into the ForexAnalytix community chat room, you have to be part of the premium product. So make sure you do so. Make sure you jump in our chat room, which is right here next to your icon, and make sure you download the mobile app, because you can use it with any one of our packages that we have. So this way you get all of our notifications right to your phone. Also, hey, one last thing, if you like this video on YouTube, that always helps us out. Also hit subscribe so you never miss any of our content that we post to our YouTube channel. Okay, I got all that out of the way. Let's talk about this next week. Really important week this next week. Why? Well, we have a couple central bank meetings that are important. We have, if you can look here on the calendar if you want on ForexAnalytix, but we have the Bank of Canada this week. We also have the European Central Bank. Two really important central bank meetings this week. Also, I guess we have the Bank of Japan as well. Probably not going to be as important as the other two. Really, the ECB is the one you want to keep your eye on. But what is really interesting is we closed the week at all-time highs on the S&P. Now, we closed above the 161% extension of the sell-off that we had. You can see it right here. The sell-off that we had at the end of 2018. We're opening 2020 at all-time highs. We're past the 161% extension, really overbought with relative strength. Can this rally continue? Yeah, I think it can. The question is, how will the FX market respond? And this is going to be really interesting as far as I'm concerned, because we're going to have one of two situations happen. We're going to have this equity market rally continue globally, and there's a lot of arguments for it. And that means we're probably going to have a catch up in risk appetite. Now, the reason why this is so important is because if you look at certain asset classes, especially like the dollar yen really important here. And let me just pull up this. I'll pull up a weekly chart just so you can see it. We're at the triangle resistance on the US dollar Japanese yen, and really a break above this 110, roughly 110.30. The market can then start accelerating higher. However, I've got a little bit of an issue with the US dollar Japanese yen right now, because some of the things that should be happening, which is not happening. Actually, let me take you over here. You'll notice the 10-year. The 10-year and the forex market, and especially the US dollar Japanese yen and the bond market, really have been moving hand in hand. In order for the US dollar Japanese yen to really move higher, to really blow up higher, we need yields, bond yields, to start moving up as well. And as you can see, the 10-year, we're in this channel, and we have the 200-day moving average just below and right at really key support at the 128 level on the 10-year. My question is, will bonds start to sell off as equity markets accelerate? That's one. The second issue that I have right now is the gold market. The gold market, let me get over to gold really quick. The gold market should be coming down, but you can see gold's holding up really well, and you can actually argue that we're developing some sort of pennant formation here that looks something like this, which is actually bullish, has bullish potential. All right, and with the stock market going higher, gold should be coming down, bonds should be coming down, yields should be going up. So I think if those two things happen, we see gold come down, we see bonds come down, yields go up, then that might open the door for the US dollar Japanese yen to finally break higher above this multi-year trend line. This is a multi-year triangle, and let me let my charts catch up a little bit with my words. But you can see we're right up against triangle resistance, and we're really struggling right here. All right, and above 110.30 or so, then you might have the market play catch up. Now, the flip side to that is, how about if I'm wrong? How about if I'm wrong and the S&P really stops at this big resistance that we're at, which is, like I said, the 161% extension of this move. It's also, this is a what you're looking at here versus I was showing you the actual index, the cash index. This right here is an ETN, or that FXCM provides, which is very very much like the S&P futures. You can see we have 161% extension to the post-Iranian conflict, if you will, 2 weeks ago. 161% extension of that 2018 move. We are above those levels, which comes in, roughly about 10 points below where we're at, and we closed above it. But the charts are still the same here. The stock market looks like it will continue. We're going to continue to accelerate and possibly ramp, have maybe a blow off top higher, which is, you guys that are longtime listeners know, this is something I've been really hoping for. We could really accelerate, but how about if I'm wrong? How about if we reverse here and we come back down and we pull back and correct a little bit, revert back to the mean? Well, what then? And that's when I start looking at the dollar yen saying, well, if it didn't go up with the stock market going higher, then that's when you start to see the dollar yen reverse course. And that's when you also see bonds start to move up, yields move down, gold continues this rally. So we're at a very big inflection point in the FX market, especially when you're talking about the yen, you're talking about where S&Ps are at, talking about gold, and you're talking about bonds. Now, you might say, well, Blake, where does that leave the euro? Well, the euro's sidelined. As you guys know, we're just kind of bouncing around. We're back below the 200-day moving average. It's very choppy. Let me pull up ForexAnalytix. Even though this is not my analysis, this is one of my team members. This is actually Steve's, and well, there's Paul Franco's, there's Steve's. You get a bunch of different analysis here. The euro dollar is actually setting up for downside. We've got this nice little head and shoulder pattern developed, but whether or not we sell off has more to do with the ECB happening this Thursday, and also risk aversion and risk appetite. So let me give you a couple little warning here. In order for the euro dollar to sell off, we need the ECB to stay on its current course. We do have an ECB president. Some economists are starting to speculate that ECB Lagarde, she might turn a little bit more hawkish than previously expected. If that's the case, the euro is going to have a hard time going lower. In addition, the euro has been a big funding currency, and for carry trades, and that's important to understand, because in the event the stock market actually reverses lower, which I don't think it's going to, but like I said, there's some things standing in its way right now regarding bonds, gold, yen. If the stock market starts to show some signs of weakness, which we haven't seen yet, but if it does, that might actually take the euro higher, where those carry trades start to unwind. So a couple things really important to pay attention to this week regarding the euro. What does risk appetite do is one. Two, what does the ECB do on Thursday, or how do they sound? And do they sound more hawkish than the market expects? Those are things that are risks to the euro bear case. Now, one last thing I want to talk about before I let you guys go. We have the Canadian. The dollar Canadian is in breakdown territory. Let's all keep that in mind. We had this big triangle consolidation. We're starting to break down. The dollar Canadian looks like it can break down. However, I'm going to do a little bit of drawing here for you guys. You can see it on my charts, just so I can draw. Okay, that's a daily chart. I think this will be fine. Okay, so while we are below 131, the risk for the US dollar Canadian is lower. This is another one of those currencies that I think a lot of us scratch our head and say, all right, stocks are higher. Why isn't the US dollar Canadian lower? VIX is lower. The VIX and the dollar Canadian have a historically pretty strong correlation. Why has the dollar Canadian not dropped down below 129, maybe towards 128? I think a lot of us are scratching our head. But with the Bank of Canada on Wednesday, if they start citing some recent, weakness in Canadian data, which, by the way, the Canadian data has been notoriously weak as of late. What happens with the dollar Canadian? Does the dollar Canadian break back above 131? I think the risk to the bear case of the US dollar Canadian shifts slightly if we get back above 131. And for sure, in my mind, if we get back above this trend line, which comes in, think about Tuesday, roughly around 131.60. So, I, for one, I like to look for, what does the market expect, and then what does the market do? Like I said, I think many of us feel that dollar Canadian should be lower in price. And I feel that the market might be positioned that way as well. Technically, it looks bearish, but it's not going to look so bearish if we get back above 131 or we get back above 131.60. And with the Bank of Canada rate decision on Wednesday, those are the risks if you are a US dollar Canadian bear or you're a Canadian currency bull. Those are the risks going into this next week. And obviously, if we get back above the 200-day moving average, that's when the squeeze really starts. But that's neither here nor there. I don't think that's really a risk at this moment. But going into this next week, it could be, especially if we get above 131. So, guys and gals, look, you've heard me ramble a little bit about the FX market. But one place that you can find me all week long is in our ForexAnalytix members chat room, our community chat. That's where I'm at all week long, and all you have to do is click on this icon right here and it'll launch it. But I actually have it right here, so I can't put it in two different windows. That's why it says that. But when you click that icon, it launches the chat. That's where I'm at throughout the course of the week. You want to ask me anything, you want to see what I'm thinking, you want to see what I'm trading, which I'm constantly in and out of the market. That's where you're going to find me and the rest of the team and be able to pick our brains. So make sure you take advantage of the current offer that we have with ForexAnalytix, because like I said, it only comes around once a year. Guys, if you like this video, you think it's going to be helpful for you next week, make sure you give us a thumbs up. It always makes us feel good for producing these videos each and every Sunday for you. And I'll see you tomorrow morning on the FACE webinar. My name is Blake Morrow. I'm with ForexAnalytix. I hope to see you in our community. Have a great remainder of your weekend. Oh, by the way, it is Martin Luther King holiday tomorrow. The stock market will not be open. We will still broadcast. It might be a little slow in the FX market, but the rest of the week should pick up with volatility. So have a great one. I'll see you tomorrow morning.